Hello everybody, Angmo hates China, so I buy Capitaland China Trust at 1.04. So comrades, here I come at 0.75 price to book. I think this is roughly a 0.75 price to book. NAV is roughly 1.3, but the NAV of as of latest reporting date is already down from the year before because of the FX effect of Sing versus CNY. So it really depends on where the FX rate ends up. But it's looking at the 0.75 price to book, or even lower if you think the NAV in Sing terms is higher. So I think if you hate China, you will hate this REIT. But if you don't mind China, I think it's looking rather interesting, attractive, at least to me. This is the share price performance of the REIT as of year to date, and of course this is the early play on the China recovery, right? And very quickly everything simmered out, and you can see over here is a big sell-off over here, and I think the shorts are all in already. People are now bearish on China, and shorts are coming in, shorting the shit of everything linked to China. So you see this counter falling, you see China stocks falling, you see Alibaba falling, everything's falling. Of course, this is the main reason. The first quarter GDP only 4.5%. That looks good normally. Okay normally, but if you think about the base last year was really weak, people were expecting this number to be a lot higher, right? So actually, I am surprised as well at the number being so. I expected a much higher number for this. So 4.5 is definitely a disappointment. But I think in reality, what's happening is that the effects of the real estate crackdown imposed by the CCP is really having a big effect on the entire economy. Consumption is low because of the wealth effect disappearing. If you have, I mean, the Chinese have a lot of their wealth in properties. So if you see the properties are falling in price, you feel poorer and don't spend. And investments are down. Banks are now loaded with non-paying loans to the property sector. Property developers cannot deliver the properties. So the entire economy is screeching to a slowdown. The real estate problem is real, and it's a big problem, I think. But on the good side, though, on a slowing China economy, this is not gonna cause too much inflation to the rest of the world, which is one of the big worries over here actually. Will China reopening lead to a huge spike in commodity prices and consumption, leading to a hike in inflation globally, and thus forcing the central banks to raise rates even further? I think all their worries have disappeared, and therefore, in the world of REITs, the point of view of REITs, that might not be a bad thing. A not too fast growing China might be a good thing for the world economy, I think. Of course, now the analysts and all those Angmo people are competing to be as bearish as possible on China. So on the FX side, they're calling for depreciation of the renminbi against the dollar to 7.2, 7.3. The worst I've seen is 7.5. So now it's a competition amongst the Angmos to be as bearish as possible to create as many headline grabbing, eyeball grabbing headlines of being bearish on China, of China collapsing. It's now a competition to be as bearish as possible. But of course, when people are bearish, I think it's good to take the contrarian view and take a stake in something. Which is why I bought CLCT 1.04. I think it's looking really cheap. Only problem is that I don't know whether it get cheaper. In fact, I suspect that it get cheaper though, because now that it's at 1.04, psychologically, I think there's a big attractiveness for the short sellers and the bearish people to short sell this stuff to below 1.00, which is the very attractive round looking number, right? People will try to short this fella below 1, and then after that scream bearishness and calling for a big sell and so on and so forth. I don't know this will happen, but I think at some stage you just have to bite the bullet and buy something when the value emerges. Let's think about let's think about the fundamentals of the REIT and what really matters, which is the DPU. So first of all, you have the revenue, right? So is the revenue going to be better or worse? I think the revenue will be better actually. So if you look at the portfolio for CLCT, you have retail, business parks, and logistics. Retail is the even after the diversification into these two segments, this is still the biggest part of the portfolio, right? So I think this segment is definitely going to pick up. You have rental reversion is positive, which is definitely gonna happen, right? Because the rentals people pay during the COVID lockdowns is really low. So now is a recovery, and people are now traffic is higher, sales are higher. Therefore, rental reversions you have to be we have to be positive, but quite a fair bit. And more importantly, now that things are kind of back to normal, you don't have the rental rebates given already, right? So you have the twin tailwinds of higher rental reversions, as well as the absence of rental rebates. So I think this segment is going to do very well. I think logistics is going to be established. If you look at the guidance from Maple Tree Logistics Trust, they are saying slowdown in the logistics sector in China, so I believe in it. But nonetheless, I think the well is still quite long, occupancy is still quite strong, so this should be stable. I'm a bit negative on the business park segment of the CLCT. Occupancy is just 90%. If you read the news, I think offices and business spaces are getting a big slowdown because of the slowdown in the economy. So commercial people are not really that aggressive in taking out space to expand, and even if they take out space, they're not willing to pay a high rent. So I'm negative on this segment. Kind of okay on this segment and positive on this segment, but because this segment is so much a big part of CLCT, therefore, and the overall, I think the revenue perspective should be positive. Then let's look at the interest cost. I think this is where it gets interesting because for the Western world, inflation is still getting out of control, right? In fact, yesterday you read the PCE from the US. The core PCE is still rising. I think this is going to force the Fed to stay higher for longer, which is something I've been talking about for the past few weeks actually. I think the market is completely wrong in saying that the Fed will cut rates aggressively this year. I think the Fed will stay high for longer, at least for the rest of this year. Maybe start to cut a little bit by 2024, but then even then the extent of the cut is still uncertain. But in China, interest rates are going the other way. I think PBOC might have to lower interest rates, and therefore you have a case of falling inflation in China, falling interest rates, which might be a good thing for the REITs. In fact, you look at the funding sources for CLCT, only 13% of the loans are onshore, right? So they can actually take this opportunity to refi a lot of their debts offshore into onshore loans at maybe even lower rates, because rates in China are now lower than that of US, right? Look at the onshore LPR of China, it's around 3+%, and then in US it's 5%, right? So actually onshore loans might be getting more attractive relative to offshore loans. So that's quite attractive for CLCT, right? Especially when this is a natural hedge. So they borrow onshore in renminbi to fund their assets in renminbi, right? So it's perfect. So I think CLCT is actually in a very unique position to benefit from lower rates in China. Then finally, you end up with DPU in CNY, right? And then you translate to DPU in Sing. And this is where the biggest uncertainty lies. Where will the FX of CNY against Sing end up, subsequently? I'm more positive on the Sing versus CNY. For reasons I'll talk about subsequently. But if you look at it, the revenue is higher, interest cost might be lower, and if the CNY does not depreciate too much against the Sing, actually the net overall effects should be positive. So I think the TPU for CLCT in Sing terms might be better than what people would expect to happen. So let's talk about the FX effect. So this is the dollar versus renminbi on a 5-year perspective. Of course, if you're the Angmo, right, you look at this chart and go, oh no, this is collapsing to infinity. So let's sell everything, right? So this is the Angmo point of view. But I think from the Singaporean point of view, this is the FX effect. So the yellow line is dollar versus renminbi, and the blue line is the renminbi versus against the Sing. You can see that actually Sing for the last 6 months has actually been stronger versus the renminbi compared to the dollar. So the MAS actually allowed the Sing to appreciate against the renminbi at a faster pace than what the dollar has been doing to the CNY. I think this is not sustainable. If you look at the economy of Singapore, it's also grinding to a slowdown. If the MAS persists in allowing the very strong Sing versus the CNY, exporters in Sing will suffer big time. And with the inflation in Singapore, I think gradually returning back to more normal levels, albeit a slightly higher level, I think the MAS will allow the Sing to depreciate subsequently, at least not be so strong against the rest of the world, and therefore maybe Sing China will stop appreciating so much. In fact, it will come down subsequently, although dollar China might continue to go higher. So I'm a bit more positive on the Sing versus CNY than what the Angmos would have with their US dollar versus the renminbi. So let's think about what DPU would be then. So during the extremes of the lockdown in 2020, DPU was 6 cents, right? 6+cents. And then it went to around 8+cents. And then last year was 7.7 cents, 7.5 or 7.7 cents. So what would the DPU be? I think the it's not gonna return to 6 cents. So even if it returns to 6 cents at 1.04, I'm getting roughly a 6% yield, right? Which is okay-ish, I think. But more probably, I think given that last year was 7.5 cents or something, it will probably end up being higher than 7.5 cents. So at 1.04, which is my purchase price, I'm getting more than 7.5% yield. And with a bit of luck and a much stronger performance from the retail segment, I might get more than 8% yield on this position, which is pretty attractive, I think, given the fundamentals and that it's run by a pretty decent manager in Capitaland, right? So I think the conclusion, what is bad for the Angmos might not be a bad thing for Singaporeans. So when Angmos are selling, I think it makes quite a fair bit of sense for me to purchase a stake right now. And if things fall even more, I might just pick up more.